oil above $100, fertilizer prices spiking, Europe is heading for recession, the Fed is frozen, and behind the scenes, helium supplies for the chips that power every AI data center are running out in months. It sounds like the end of the world, but I think most people are looking at this wrong. Hey, welcome back. I'm Kirill Delay, investment analyst with over a decade of experience. Here we connect the dots between macro, crypto, and AI. No noise, just what actually matters for your portfolio. 3 stories today. First, the oil shock is deeper than the headline price. I'll show you exactly where the real damage is hitting and who's most exposed. Second, why I think this doesn't last, the political math, the positioning data, and the number that tells you we're not at the breaking point yet. And third, while everyone watches the war, AI just hit a milestone that changed the math for entire countries. Not companies, countries. Quick disclaimer, nothing on this channel is financial advice. I'm sharing my views and analysis, but always do your own research before making any investment decisions. Let's start with oil. Everyone sees the headline, Brent above 100. Painful. But the headline is actually the least interesting part. Let me show you what's happening underneath. Now let's start with the US. America is a domestic energy producer. So $100 oil isn't existential, but it's not painless either. The Fed's models show that a 10% increase in oil prices shaves about 5 to 10 basis points off GDP. Oil is up roughly 45% from its baseline. So that's about 1/4 to 0.5% off GDP. On the inflation side, that same move adds roughly 0.5 percentage point to headline inflation within 3 months. On top, what's been already sticky. So gas prices are climbing, voters feel that immediately, and the Fed is stuck. They can't cut because inflation is rising, and they can't hike because the labor market is softening. $100 oil makes their life significantly harder. So for America, this is manageable. It's painful, it's political, but it's not existential. Europe is a different story. Europe is where it gets really painful. Historical sensitivity analysis shows that for every 1% increase in oil prices, Eurozone GDP drops by about 0.02%. Sounds small, but oil hasn't gone up 1%. If oil doubles from its baseline, that's a 2% hit to GDP. The Eurozone was only growing at 1.2% before this, so do the math. That puts Europe into a recession. And on inflation, the same doubling adds over a percentage point to Eurozone headline inflation within 3 months. So the ECB, the European Central Bank, has a single mandate, price stability, 2% target. If inflation is heading to 3% or higher because of oil, the ECB has to respond. And some governing council members are already talking about rate hikes. But here's what most people are missing entirely, I think. Oil is not the only thing that flows through the Strait of Hormuz. About 1/3 of global fertilizers transits the strait. Urea, for example, is already up over 20%. During the Ukraine war, when fertilizer supply got disrupted, Eurozone food inflation hit 15%. Food is roughly 1/5 of Europe's inflation basket. So that's another inflation layer coming that has nothing to do with oil. So it's on top of oil. And then there is helium. 35% of global helium supply goes through Hormuz. For Asia, it's over 50%. Helium is critical for cooling semiconductor manufacturing equipment. TSMC, for example, the company that makes most of the world's advanced chips, has roughly 3 to 4 months of reserves. There are no strategic helium reserves, no pipelines, no policy tools. If the strait stays closed for months, the chip supply chain stalls. And that affects everything from data centers to cars to phones. So the picture is oil is the headline, but underneath there's fertilizers that are spiking, food inflation is coming, and a countdown on semiconductor production has quietly started. The US gets hit through inflation and a paralyzed Fed, but Europe is taking the full structural force. This episode is brought to you by Anderson, a global software development company building high-quality custom solutions for finance, healthcare, and beyond. I just laid out a pretty dark scenario, I know, but I don't think it gets there, and here's why. Let me start with the number. Oil's long-run average price sits around $80. The historical recession threshold, the level where oil actually breaks the business cycle, is about 50% above that, so roughly $120. Right now, we are trading around 100. That puts us in the pain zone, not in the danger zone. Every oil-driven recession in the post-war era required prices to push more than 50% above the long-term equilibrium and stay there for months. We're not there. We're about 2/3 of the way. Oil at 100 is a headache. Oil at 100 plus, sustained for months, is a heart attack. The data says we are at the headache stage. And here's why I think it's unlikely that we're going to reach the heart attack stage. Three sources of pressure are converging on this conflict, and all three point toward resolution, not escalation. First, domestic pressure on Trump. Polymarkets give Democrats an 85% chance of taking the House in the midterms at the end of this year. And just in the last few days, the Senate flipped to 51% probability that Democrats take the Senate. That wasn't the case a week ago. So probably driven by gas prices. When gas at the pump spikes 30 cents in 2 weeks, voters feel that immediately. Trump cannot afford even $120 oil going into an election. We've seen actually this pattern before. China trade war, Greenland Liberation Day. The playbook is always the same. Escalate hard, get the headline, then reverse. And remember how China played it. They knew exactly where to push. The stock market. Every time markets dropped, Trump eased his demands on trade policy. And I think Iran is playing the same game. They've publicly stated their goal is to push oil toward 200. Trump has publicly shown he wants low oil and high markets. Both sides have shown their cards. The question is now who blinks fast. And the political calendar is ticking for Trump. Second, the Gulf states, Dubai, Qatar, Saudi Arabia, their entire economic model is built on one story: stability, safety. Come park your wealth here. That story is now broken. Dubai is getting droned. Capital controls are going up. And we can see the capital flight in real time. USDC, the biggest regulated stablecoin, went from 70 billion in circulation at the start of February to over 79 billion by mid-March. That's $9 billion of new inflow in 45 days, of which 4.5 billion came since the outbreak. Now, is all of that from Dubai? No, probably not. There are other factors, of course, but the spike is there and the timing lines up almost perfectly with the conflict. Also, the Gulf sovereign wealth funds hold about 30 to 40% of their portfolios in US assets. They have leverage over Trump, and they're going to use it. Because the longer the conflict drags, the more capital leaves the Gulf, the more their economic model erodes. They need resolution as badly as Trump does. Third, Iran itself. Look at the numbers. On day one of the conflict, Iran launched 350 to 480 missiles. By day 15, that number had dropped substantially to 25 to 40. That's a 92% collapse in launch rate. Their navy have been declared combat ineffective. 43 vessels destroyed. This is not a country projecting strength. This is a country managing decline. They can still cause pain, they can still disrupt Hormuz, but their ability to sustain that disruption is degrading by the day. And they know it. So, you have three parties, all with the incentives to find the exit. Trump because of midterms, the Gulf states because of capital flight, and Iran because its military capacity is collapsing. And then there is what the market is actually doing. Last week, saw the largest net outflows in US index futures in over a decade. On a net basis, worse than COVID. The energy trade is the most crowded position in the market. Consumer discretionary is the most hated. And everyone has piled into the same side of the boat. When positioning gets this extreme, the pain trade reverses. If the conflict de-escalates or supply chain adapts faster than expected, the snapback will be violent. Not because the fundamentals suddenly improve, because everyone who sold has to buy back. So, my read. The risks from story one are real, but the political math, the position data, and Iran's own military situation all point towards resolution, not permanent disruption. So, I'd start looking for re-entry points relatively soon. If this kind of analysis is useful to you, subscribe and turn on notifications. I put out new episodes every week, connecting the dots between macro, crypto, and AI. Don't miss the next one. Now, one more thing. Because while everyone is watching the war, the oil price, and the central banks, something happened in AI last week that I think is going to matter a lot more in 12 months than anything we just talked about. Last episode, we covered the exponential growth of Anthropic's revenue. 1 billion to 20 billion in 15 months. 80% from enterprises. That was the demand side, the demand signal. Today, I want to show you the supply side, how fast the technology itself is improving. Because there is one chart that I think is the most important chart in AI right now. There's a non-profit called METR that tracks one specific thing. How long can an AI model work autonomously on a real software engineering task before it gets stuck and needs a human? In 2023, the answer was about 10 minutes. By early 2025, it was an hour. The latest models, as of this month, can work for over 15 hours straight. This is not a linear improvement. That line is going vertical. And it matters because it marks a specific transition. 10 minutes means AI can autocomplete your code. 1 hour means it can write a function. 15 hours means it can build an entire feature, debug it, test it, and ship it while you sleep. That's the jump from assistant to autonomous worker. And it happened in less than 2 years. And the products built on this capability are scaling at speeds we've never seen before. Cursor, an AI coding tool that launched 2 years ago, hit $2 billion in revenue last month, doubled from 1 billion in 3 months. That makes it the fastest scaling software company in history. And 60% of that revenue comes from enterprises, not individual developers. Companies replacing their internal development workflows. And what are the incumbents doing? They're cutting to keep up. Meta announced last week that it's planning to cut up to 20% of its workforce, about 15,000 people. The reason? To fund $135 billion in AI infrastructure spending. The stock actually went up 3% on the news. The market is rewarding companies for replacing humans with AI. That's the signal. And this brings me to the part of the story that I think most people haven't processed yet. The Philippines. The country's single largest private employer is the BPO industry, business process outsourcing. Call centers, customer support, back office operations, nearly 2 million workers, $42 billion in revenue, over 8% of GDP. And 89% of that employment is concentrated in contact centers, the exact segment where AI is hitting the hardest. Let's take Klarna as example, the Swedish payment company. They deployed an AI customer service agent that cut their cost per resolution from about $6 to 10 cents. It handled over 2 million conversations in a month. That's the work of 700 human agents. Now, if one company in Sweden can cut customer support costs by 98%, what does it mean for a country where customer support is the economy? The International Labour Organization says 89% of the Philippine BPO workforce faces high automation risk. The World Bank says 36 to 40% of all Philippine jobs are highly exposed. And the country has no national AI policy framework, no workforce transition program, nothing. This is the shift. It's not just companies anymore, it's countries. Last episode, we talked about AI disrupting business models and how to prepare your portfolio for that shift. But this is the next phase. When the cost of a service collapses by 98%, it doesn't just change a company's margin structure, it rewrites the economic logic of an entire country that was built around providing that service. And unlike the oil shock, this doesn't reverse. When the war ends, oil normalizes, shipping lanes reopen. But AI going from 10 minutes of autonomous work to 15 hours, that doesn't go back down. Cursor hitting $2 billion revenue. Those enterprise contracts don't get cancelled because Hormuz reopens. Meta cutting 15,000 people. They're not rehiring them when oil drops. So, what I want to say is that the war is temporary. The AI shift is not. And if you are only repositioning your portfolio for the first one, you're missing the bigger trade. That's it for today, guys. 3 things. 1. The oil shock is real, and it's deeper than the headline price. The US feels the pain, but Europe is the most exposed. Fertilizers, helium, and gas are all adding layers on top of oil. 2. But the political math from Washington, the Gulf, and Iran's own military collapse all point toward resolution. Positioning is at extremes. If it resolves, the snapback is violent. I'd be looking to get back in relatively soon. 3. AI capability just went vertical. And for the first time, the disruption is hitting at the country level. The war is temporary. The AI shift is not. Tell me what you think in the comments. Like, subscribe, notifications on, and see you next week.